Hope you love the channel and find it useful in becoming a happy retiree. Subscribe today. I'm covering one of the biggest debates we have ever seen in our industry, which is this active passive debate, the giant debate. Two major studies have come out in the last couple of weeks that completely butt heads and completely contradict each other, leading to the confusion for investors. As we dive into what is this giant debate, and I know that we touched on this last Sunday, we got a bunch of calls about this, and folks want to hear about what's better, Wes? What's better? Do I just do index funds and become a passive investor, or do I buy stocks and try to get tricky in markets, or is there somewhere in between? And that is the debate we're going to try to solve here today in the swirl of geopolitical churn. So we're going to go to this debate. Last 20 years, 30 years, it just gets it just continues to heat up. The RPMs continue to go higher and higher into the red zone. Do you sit still? Do you sit still in some sort of market index and just take your ups and your downs and your lumps? Leave it and leave it and leave it, no matter what happens in markets? Or do you try to do something, or do something more strategic than that, a little more thought out? That's what we're going to try to solve for today. There are these two massive studies that really just, they contradict each other. One done by S&P, Standard & Poor's, which has a lot of validity and a lot of credibility and respect behind it, and one by Morningstar and PIMCO, which again, a lot of credibility and a lot of respect behind that. And as an investment advisor, I've got to, and a host here of Money Matters for a lot of years, the most important part of my job is to educate about the facts and the fictions. And there's a bunch of fake news that goes on in investing. Hey, fake news, it might even have been invented in the investment world. Now there's fake news everywhere, but it's always been in the financial sector. So I'm trying to help you to decipher what's fact, what's fiction, and what's in between. And I got an email about a couple weeks ago from a radio listener, and it kind of sparked this thought of, I really need to think this through and write about this. And by the way, I wrote about this. It'll be in the Atlanta Journal-Constitution this Tuesday in the front of the living section. So if you miss the show here today, you can read about this debate, the active versus passive investing debate, AJC, on Tuesday. But the listener says, hey, Wes, I've been using active mutual funds for years. I want to rebalance the portfolio, and I want to use passive investment vehicles. Is it time, she said, Wes, is it time for me to become just a passive investor? Now, let me try to answer that question today here on Money Matters, because I think it applies to so many of you listening at some point in your investment life cycle. So let me first define these two areas. So you've got active, and then you have passive, both investing styles. Passive investing, by strict definition, entails owning the market. Hey, just own the market. Or just own a broad market indexed fund and never trade it. Add to it, never rebalance it because it's just the only thing you own, and you just live with it. As a reminder, though, remember, you can't own an actual index. They're not for sale. You can own a fund that tracks an index and is pretty darn close, or an ETF, exchange-traded fund, that tracks an index. But remember, it's got to be in some sort of vehicle or fund, and there's some cost associated with it no matter what you do. So there's no such thing as an actual index that you can invest in, only a fund that tracks an index. Active investing, and this is where I think I'll bring a lot of light to this. Active investing, it by nature, is really anything besides a pure buy and hold strategy. So if you're doing anything beyond just owning, let's call it the S&P 500 fund or the World Index Fund or the total bond market, if you're doing anything beyond just that, technically it's active. So for all intents and purposes, there's really no such thing as pure passive investing, just various shades of active investing. And I'm going to get back to this in a minute. And again, part of this goes back to, in reality, what do most people do? Yes, there are people that'll buy an index and that's all they'll ever do, and they'll sit there forever. And that happens. And there are certainly investors that do that. Not a giant percentage, though. I don't know the exact percentage. I don't know if I've ever seen a study that says this amount of people are just totally passive and they never change anything. They sit in an index. Maybe it's 5%. Maybe it's up to 10. But 90% of folks are doing something that technically, whether they say they're active or passive, it's technically active, because anything beyond just sitting in an index is some version of active investing. For instance, if an investor chooses to hold, let's say, just the S&P 500 fund, widely regarded as passive, by the way, I just own the S&P, I'm passive. Well, you're inherently making a decision by doing that to hold only United States stocks, which by nature is an active decision, only to invest in about what's 10% of the world's $240 trillion investable marketplace. So again, there are about $240 trillion worth of investments around the globe, stocks and bonds and real estate, pipelines, U.S., international, real estate, REITs, U.S., international, bonds, U.S., international, emerging markets. There are choices all over the world. There's hundreds of different indexes. I downloaded into Excel to try to count how many indexes there were, and I lost count over 400 different just indexes to track. Now you can start to understand why there are thousands upon thousands of mutual funds, because there's all these different iterations of all these different indexes. So which one do you own? So when you own an index, by nature, out of the gate, that's an active decision to pinpoint one area of the world. Furthermore, any time you use many or multiple passive vehicles, so think, I own 10 different index funds or 5 different index funds and 3 different ETFs. Now, by nature, even though you own a bunch of passive vehicles, by nature, now you've got an active strategy. So the real genesis of this whole argument, I think, this whole debate, active versus passive, the real question from our Money Matters listener that they want to know, I think, it really comes down to performance. That's what we're really asking here. What does better, active or passive? Is it true that the vast majority of active funds are bested by their index fund counterparts? The answer to that is some do and some don't. And it's a very large continuum between the two. It is not black and white. It is not the headlines you read. Standard & Poor's study said, look, at 90% of actively managed funds underperform their index over 15 years. Then a PIMCO Morningstar study says, particularly for bond funds, the exact opposite is true. So which one do you believe? We're going to solve it right here today on Money Matters. Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.